Welcome to vTalkInsight, Risk Sentiment Daily for March 19, 2026. The key story now is how a deepening Middle East energy shock and sticky inflation are colliding with surprisingly resilient equities and a still dovish Federal Reserve. Let's unpack what that mix means for risk appetite and where the balance of risks is shifting today. Risk sentiment has shifted back toward a cautiously defensive stance, with downside scenarios getting more attention than they did even a few days ago. The deepening Middle East energy shock, tighter physical oil markets, and hotter inflation prints are all feeding a more fragile macro narrative. In U.S. equities, prices fell by a little more than 1% yesterday, while volatility measures moved back into the mid-20s. That pattern is consistent with a market that is still invested, but increasingly aware that the balance of risks has tilted to the downside if supply disruptions and inflation pressures persist. Even so, this is not an outright capitulation. Corporate earnings expectations, particularly for the S&P 500 this year and next, continue to edge higher, and analysts have not yet taken a knife-to-profit forecasts despite the energy shock. At the same time, the Federal Reserve has chosen to hold policy steady and has kept its projected rate cuts on the table, signaling a willingness to look through some of the near-term inflation noise. The result is a split regime. Energy, rates, and credit argue for caution, while equities and structural growth themes still support selective risk-taking, often with bigger cash buffers and more use of hedges rather than broad de-risking. The most powerful bearish force today is the Middle East energy shock and supply risk. Disruptions around the Strait of Hormuz, with Iran exerting control over vessel passage and targeting ships, have created a bottleneck in one of the world's key choke points. Brent has moved well above $100, but the real stress is in physical barrels. In hubs such as Singapore, Rotterdam, Oman, and elsewhere, spot prices for crude and refined products have surged far beyond headline benchmarks, in some cases above $200 a barrel, signaling acute shortages that paper pricing has yet to fully reflect. This physical tightness is being compounded by structural issues. There is little spare production capacity. Inventories are being drawn down rapidly, and China is reportedly running through stockpiles at a pace that could exhaust significant reserves within weeks. If disruptions around Hormuz persist, several scenarios point to oil moving higher still, with some estimates talking about levels that could force demand destruction and raise global recession risk. Policy support is also constrained. Allied governments in Europe and Asia have been reluctant to commit naval forces, and there is no clear diplomatic off-ramp in sight. The market is therefore building in a lasting geopolitical premium, particularly in longer-dated contracts, but there are signs that broader risk assets may still be too complacent about severe downside scenarios. For portfolios, the key watch points are the persistence of shipping disruptions, the gap between physical and reference prices, and any evidence that higher energy costs are starting to damage demand or corporate margins. A second major bearish driver is persistent inflation and higher-for-longer rate expectations. Recent U.S. producer price data came in hotter than expected, with a monthly rise of around 0.7% pushing the annual rate into the mid-threes. Core personal consumption expenditures inflation is still running at about 3%, well above the Federal Reserve's 2% target, and recent energy price moves have not yet fully fed through into those numbers. Goods prices, including food and some agricultural categories, have seen outsized jumps, underscoring the supply-driven nature of current price pressures. In response, market pricing has shifted significantly. Expectations for near-term rate cuts have been pushed out dramatically, with some curves now implying no meaningful easing for several years, and even some risk of renewed hikes if inflation remains sticky. That backdrop reduces the policy cushion for risk assets. As long as inflation stays elevated and energy shocks threaten to push it higher, it is harder for central banks to provide support if growth slows or unemployment rises. The tension is that while the Fed's own projections still include cuts, investors are increasingly preparing for a scenario where rates stay restrictive for longer, keeping pressure on valuations, particularly in rate-sensitive sectors, and sustaining demand for cash-like instruments and high-quality fixed income. The third important bearish driver is broadening private credit and funding stress. After years of easy money and low defaults, direct lending is now seeing a clear regime change. Default rates that sat around 1 to 2% are moving into the mid-single digits, and several analysts expect a multi-year period of elevated defaults stretching into the later part of this decade. Returns that once looked comfortably in double digits are normalizing toward mid-single digits, reducing the appeal of illiquid credit where transparency can be limited. At the same time, concerns are rising about the plumbing of this market. Redemption clauses in semi-liquid vehicles are being tested, valuation practices are under scrutiny, and there is anxiety that, under stress, private funds could draw heavily on committed bank credit lines. While most observers still see systemic risk as lower than before the global financial crisis, this kind of leverage on leverage can transmit funding pressure into parts of the banking system. Credit tightening is already broadening, making refinancing harder for weaker borrowers and potentially weighing on investment and growth. For portfolios, this argues for close monitoring of exposures to private credit, bank credit lines, and sectors reliant on sub-investment grade financing, even as higher quality, asset-backed areas such as residential mortgages and aviation appear comparatively better anchored. On the bullish side, resilient equities and strong earnings momentum continue to provide an important counterweight. Despite surging oil prices and intense geopolitical headlines, broad equity indices have held up better than many would have expected, with the S&P 500 recently maintaining key technical levels even as recession odds have drifted higher. Corporate profit expectations are proving sticky. Analysts have raised earnings forecasts for this year and next, and there has been little move yet to downgrade numbers in response to the Middle East conflict. In effect, markets are signaling a belief that, while the energy shock is serious, its direct hit to global earnings may still be manageable. Under the surface, the picture is more nuanced. Volatility is elevated and sector rotations are sharp, with some areas of the market down around 30% while others are up by a similar amount. Yet clients are not engaging in wholesale de-risking. Flows show a tilt toward adding hedges and holding more liquidity, but not a broad rush for the exits. This resilience in risk appetite, especially in parts of U.S. large caps and quality franchises, helps limit the downside spillover from energy and policy shocks, even if it also raises questions about whether equity risk premia fully compensate for rising macro uncertainty. A second key bullish driver is that the Fed remains dovish despite the inflation shock. The central bank has kept policy rates unchanged and, crucially, has maintained its projection for rate cuts over the coming years, even after revising its inflation forecasts higher. Headline and core PCE projections for this year have been nudged up, reflecting persistent price pressures and the potential impact of higher energy costs. Yet the dot plot still signals an easing bias over time, and policymakers have indicated they are prepared to look through some of the oil-driven volatility rather than rush into renewed tightening. This creates a notable gap between Fed signaling and market pricing. Investors have largely removed near-term cuts from their base case and, in some segments, are discussing the possibility of further hikes if inflation fails to moderate. The Fed, by contrast, is emphasizing patience and data dependence, acknowledging uncertainty around both inflation and the labor market. For risk assets, that asymmetry matters. If incoming data allow the Fed to validate its current path, the policy backdrop could turn more supportive than current market expectations imply. If not, and the Fed is forced to move in a more hawkish direction, the adjustment would likely come via tighter financial conditions and a heavier hit to valuations. The third bullish driver is AI and tech-led growth optimism. Semiconductor names and AI beneficiaries in Europe and Asia have been standout performers, with stocks such as leading chip equipment and fabrication companies rallying strongly on the back of robust demand signals. This strength is not just price action. It reflects a belief that AI-driven productivity gains and data center investment can support earnings growth even in a tougher macro environment. In several discussions, long-term AI themes are cited as a key reason why investors are willing to look through near-term energy and inflation noise. That said, the AI story cuts both ways. Rapid adoption is already driving significant workforce reductions at some firms, hinting at underappreciated deflationary and labor market effects, while the technology's unpredictability raises business model and credit risks across multiple sectors. There are also real-world constraints, including shortages of skilled trades needed to build out the required infrastructure, which could slow the pace of deployment. For portfolios, AI and related technologies are likely to remain a powerful source of dispersion, creating winners and losers rather than a simple index-level uplift and reinforcing the case for selective exposure rather than broad thematic bets. To sum up, risk sentiment is cautiously defensive, with a Middle East energy shock, persistent inflation, and growing private credit stress pulling the regime toward the downside, even as resilient earnings, a still dovish Fed, and powerful AI-led growth themes continue to support selective risk-taking. The key watch points now are the duration and severity of physical oil tightness, how quickly inflation data respond to higher energy costs, any further cracks in private credit and funding markets, and whether corporate earnings and tech momentum can keep offsetting these macro headwinds. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.